Welcome to the Whitwam Wealth Real Estate Podcast. Today's episode, Affordability Crisis.
Welcome to the Whitwam Wealth Real Estate Podcast with Scott Whitwam, your blueprint to financial abundance. Settle in as we explore the mindset and methods for wealth building through real estate.
Welcome back. I'm Scott Whitwam, and today's podcast is Affordability Crisis in Real Estate. Today, we're going to dive into the affordability crisis a little bit and talk about real estate, why it's happening, how it affects buyers and renters, and where we might be headed. The reality is there has been a real change in the housing market over the last 4 years. We've seen rising home prices, and we've seen stalled wages. So as prices are going up, people are not earning as much, so their buying power is diminishing. I just saw a report today talking about how they had to revise down the last year's numbers under the previous administration for job growth by 1.4 million jobs. It's a lot of jobs that we were told were created in 2024 that really didn't exist. They never actually materialized. It was all projected, and it was all treated as if we had this great economy with great job growth. And it shows us, I think, a little bit why interest rates are way out of whack compared to where we are in the economy. Now, we've seen some really positive things happening in the last 7 months with regards to the economy, with the reduction of government spending, with revenues coming in through, whether you like tariffs or not, revenues coming in through tariffs that overall will either help reduce the debt, which is what I hope they do with the money, start to pay down the debt, which will actually bring inflation down, or they may pump some more money back into people's pockets, give some of their own money back. Remember, the government doesn't have any money. Any money that the government is in possession of, they took from taxpayers, from citizens, from people like you and me. So if they give it back to us, I think that it will help some of these, compensate for some of these stalled wages that we've seen in the marketplace. Now, something in the last probably 90 days that has been happening is we've actually seen home prices in most markets level out, and in some markets we've seen some pullback in prices. But the problem is the pullback is not equal to or commensurate with the lack of job growth that we need to see. So there is a widening gap between wage growth and home prices, and we need to see that kind of diminish. One of the things that will help diminish it is lower interest rates. Now, at the time that we're shooting this podcast, we're starting to see interest rates come down. In fact, as the interest rates right now are at the lowest point they've been all year. And it's in anticipation that the Federal Reserve is going to finally make some cuts in their September meetings. And some people think that they may get aggressive and take a 0.5 point cut instead of just a 1/4 point. Now, I think that our economy needs it. I'm always a little bit leery about taking huge cuts. I'm more of a, start early and take smaller bites so that your transition ramp is much smoother. What typically happens when we take these big bites, we have big changes, and sometimes it can lead to unintended consequences. But the gap that we have right now is a lot of it's based upon interest rates. And when we get interest rates, I think back where they would really need to be to help the homeowners. I mean, the affordability issue has kept a lot of first-time home buyers on the sidelines, unable to buy a home. A lot of people are renting who otherwise would be able to buy. There are some cities, and we're seeing that in a lot of the metropolitan areas, where prices have run up so high they're almost near double, record high prices, while wages have been creeping up. In fact, in 2022, 2023, and 2024, we actually saw a reduction in the average household income of families. Now, in the last 7 months, we've started to see a change in that. We're starting to see household incomes coming back, But because the job numbers were so bad in 2024 and nobody knew it because they weren't being reported, we were wondering why we weren't seeing the kind of job growth that we expected. We know there's a lot of manufacturing coming back right now that's going to play a real positive role in all of this. It's going to bring a lot more jobs, a lot more good paying jobs, and help to bring some of the affordability down. Somebody asked me if we were going to see a huge correction in the real estate marketplace. They say, well, home prices are just so high. But I want you to think about this. From 2021 through the end of 2024, we saw on average about 30% inflation added in the marketplace. Okay, that includes the housing market. It costs that much more to build them. It costs that much more to insure them. It costs that much more to hold on to them. So there is a huge price increase baked in to real estate right now that has nothing to do with real estate in itself. It has to do with the huge inflation numbers that we're seeing. Now, where I'm at here in the Phoenix area, inflation was much higher than it was on average nationwide. While nationwide average may have been around 9% per year over 3.5 years, so that's where you get 30%. In the Phoenix area, we were running inflation numbers up around 16%. And so, houses are just more expensive. Houses weren't going up at a 16% rate, but the cost of living, the cost of materials, the cost of everything else in the economy was going up, and that has put some pressure. So the way you defeat inflationary prices, which is what I think we're seeing now in the housing market, we're seeing that inflation has driven some of these numbers up. How you overcome that is with wage growth and with lower interest rates. Lower interest rates and wage growth together will shrink that gap and deal somewhat with the affordability crisis and what we're seeing in the differential. If I look back, I guess it's probably 20 years ago. Let's go back 20 years, 2005 era. An average starter home was $200,000. I mean, if you think about that in my area, now nationwide, it was probably closer to $150,000. We're looking now at double that for the average price of a home in our area here. The average price of a home is getting pretty close to $400,000, 370s. And that's really tough to do when you're talking about 7% interest for a mortgage. I mean, you're almost talking $21,000 a year just in interest, which is near, a $2,000 a month payment. We'll say $1,800 a month payment just to cover the interest, and then you got to add principal onto it. So it's taken, just the average and median price point nationwide having come up takes it and makes it really, really tough. But wages will cure that. I mean, an increase in wages will help cure that. But think about if you go from 7% interest down to 4% interest, and you cut that interest per year from $21,000, we'll say down to $12,000. I mean, that's a huge difference for families and their household incomes, being able to cover that kind of interest rate, that kind of payment, and be able to still buy food, buy clothing, keep kids in sports, activities, whatever else it is, pay insurances, maintain cars, all of those kind of things. So, when we're talking about this affordability crisis, I think interest rates have a lot to do with where we're at right now. And I understand why the Fed raised interest rates back in 2021. Remember, after COVID, the federal government was pumping trillions of dollars into the economy, which caused inflation. And of course, Janet Yellen and Jerome Powell both said it was transitory, but they thought, so they waited instead of starting to raise interest rates when they saw inflation increasing. And then by the time they realized it wasn't transitory, interest rates took a spike and went way up. And it's going to take some time to bring them back down. And that was all about slowing employment, to slow inflation, to try to compensate for government reckless spending and pumping way too much money into the economy. And I think we're starting to see some positive things happen. The reduction in the government workforce is a huge positive, I think, for taxpayers. Looking more at private employment, which is much better for our economy, because remember, government doesn't produce anything. So all the money that government takes from taxpayers and then gives out in the form of programs or salaries is not producing anything. It's providing a service. I'm not saying it's not providing that, but it doesn't produce anything. It doesn't generate anything, but the private sector does. And I think we're going to start to see that help much greater. Now, during this whole time, we've seen inventories rise. So we, probably went into 2023 with still really low inventory. We've seen it start to creep up in 2024. And now we're starting to see inventory numbers back up where they're supposed to be. We still got a lot of buyers on the sideline because of interest rates. And what we've seen a lot is investors swooping in and trying to take advantage of the days on market. So if you're a seller that has to sell and your house has been on the market for 6 months, you become very negotiable on that price because you need to sell the house. And it's been sitting there for a long time. And so investors have been picking up these homes, turning them into high-priced rentals or, flipping them. The fact that investors are buying these houses up at the price they are is still helping to substantiate the prices that we have. If there wasn't the demand out there, the investor demand, we might see real estate prices come back down a bit because it would leave more opportunity then for the home buyers who would be a buyer at a lower price with the interest rates. But again, a lot of this just has to do with interest rates. And, and the interest rates affect first-time home buyers greatly. First-time home buyers typically are at the lower income earning part of their livelihood, or their lifespan. They're getting into their 20s, their early 30s, and their higher income earning years are going to be in their 50s and 60s. So they're trying to get in, get started, start to build up some equity and start to build up, some wealth. And it's hard for them right now. And I understand that. And as an investor, we have to understand that because it's playing a role on the properties that we buy. So when we're buying properties and we're pricing things at the top of the market and our houses aren't selling, a lot of it has to do with this affordability crisis, especially if you're buying what I'd consider first-time home buyer houses, 2-bedroom, maybe some smaller 3-bedroom, those kind of things. So there's a lot of impacts. It all has the symbiotic relationship. One thing changes, it throws something else kind of out of kilter. So let's talk a little bit about the rent burden supply shortages on the rental side of things. I don't do a lot in the retail rental space, but I do it on the personal portfolio and coaching space. We do quite a bit with rentals. There's a squeeze in the rental market, and in many metropolitan markets, we're seeing high eviction rates because rents are rising with inflation. And so rents are starting to price people out of the market with the low, I would say, the low employment numbers, the things that we just went over. So now as rents go up, it's creating an affordability crisis on the rental side of things and making it much harder for people to be able to afford their rent. We're seeing a lot of people creating cohabitation systems. We're seeing people still living with their parents up into their 30s. So there's quite a bit of an issue with rents because they've raised. Now, if you're an investor and you're in the rental business, this has been good for you. The only problem is your eviction numbers have increased and your vacancy times have increased. And we've seen that in the rental space. I've taken a little bit different approach with some of the rentals I have, and I've actually just said, hey, look, I've got these properties, I'm in them right, so let's make them a little bit more affordable for the tenants. Not push the top of the market. Let's make it more affordable. Let's keep the tenants in them, keep them renting the properties. Because again, with inflation, rents have been running right up with it. And so you can just assume that rents are probably 30% higher than they were just 3 years ago, just because of the 30% inflation that's in the marketplace. And when you're renting a house, it's not unlike buying your house. You should be not spending any more than about 30% of your income on rent. One of the bad things about when you are a renter is you don't get the tax deductibility of having the mortgage. And that's one of the things that's really beneficial for investors, especially if you're leveraging it. You get to deduct the interest. What else do you get to do as an investor? You get to depreciate the property. Renters don't get that opportunity. So you really should keep your amount of rent spend as low as you can compared to your income. Because what the goal is for you to get to a place where you can buy your own house. And then once you buy your own house, now become an investor. And I do actually know people that I had a client that was on a 3-year project on the East Coast, and he was renting his place on the East Coast. He didn't buy, he was renting. And yet he was buying investment properties out here. He was a renter there because of the job, but he was buying properties out here, and we were selling. I think we sold him 10 or 11 properties in this one area of town that he really liked. And he was accumulating rental properties. But the thing was, he wasn't paying that very much on the East Coast because, again, he was trying to save his money in order to continue to purchase these properties in his, that fit within his, vision or his goals for investing. So if you're coming up, if you're thinking about buying a house, if you're in that market and you're not an investor and you want to buy a house, keep your rent as low as you can for that purpose. And it may be tough in this market because most of the rents have gone up considerably, but you want to be in a place where when a lender looks at your finances, they'll be able to go, okay, hey, look, everything looks normal and right here. We can get you into a home, because I really think that's the first step. That's your first step for building wealth. You're going to need a house anyways. You might as well be paying off your own house. You might as well be taking advantage of the tax benefits that are out there and buy your own house, and then start looking how you can invest to start generating passive income as quickly as you can. So I think those are all very good opportunities when we're looking at the rental market. If you're looking at buying, being on the, if you're an investor and you're looking at being on the side of multifamily, I think that it is actually a really good opportunity right now for multifamily. And here's some advantage with multifamily opportunities and why some of the industrial investors like it. If you have a 8-unit complex and you have a vacancy, you're still collecting rent on 7 places. If you have a single family residence and you lose a tenant, you're collecting money on nothing. So you could have a property with 4 units, 8 units, 12 units, 100 units, whatever, and you have a scale of economy, and if you lose a tenant, it's not pulling the entire weight of the investment or mortgage down on it. So there's something to look at too. And I would say right now that the buyer pool on multifamily has been much smaller than what it would be. I've talked to several of my investor friends who invest in multifamily, and they were talking about some of the great deals that they are working on that side of things because there's not near the competition on those right now. Now, when the real estate market gets good again, it heats up, interest rates go down, incomes start to come up, you're going to see much more competition on that side of things. So let's talk a little bit about, maybe converting some of the properties that we currently have as investors and making them more profitable. Or even if you want to do a house hack, if you're living in your own house, want to do a house hack, some of these type of things can work. By, let's say, we did some episodes on adding additional dwelling units to create affordable housing. Well, it's a good way in this marketplace to either create some additional revenue of an existing property. A lot of the metropolitan jurisdictions, because they have a housing shortage, have eased their zoning issues and restrictions related to additional dwelling units. So you can build an additional dwelling unit on your property. If you build it right, you may be able to put 2 tenants in it and grab 2 more rental units out of it. If you're living in a house and you have room to build an ADU and you can make it so that it has separate access, you may be able to help pay for part of your expenses, part of your budget by building the ADU and renting it out also. So definitely some opportunities with additional dwelling units. The other thing you can look at doing, if you have a house that has a carport area, maybe you build that into living space and make it an additional dwelling unit, like a mother-in-law suite, casita, whatever, but give it a separate entrance. And now you're living in the main house. You have somebody living in what was your carport area, and you're generating revenue from it, rental revenue from it. So I think there's a lot of opportunities of how to maximize the value of a home. And maybe you've got a rental right now and it's a 3-bedroom. I would suggest looking at ways that you can add maybe a 4th bedroom, or look at converting the current rental property into a co-living facility and add multiple tenants, because you can generally get a higher price per room rate than what you can as a single unit for it. I think these are some of the investing opportunities that are out there in the current market that we're in. And making some of these moves will position you when the market gets, I think, much, much better. There are several programs out there, the debt service cover ratio loans, that will actually, a loan you can take out and just need to show that the property is generating enough revenue to cover the rent to finance it. You don't have to go through a full qualification for or full qualifying doc loan in order to put financing on some of these. So you may be able to pick up an extra property, create a co-living deal, maybe even add an ADU or additional rooms in it, and maximize the value of it. So that's an option. The other is fractional ownership. Maybe you get together with a bunch of friends. You say, hey, we want to own a property. And 3 people go together in a 3-bedroom house, and everybody shares the common areas, but each of them basically own their own bedroom space, and they split it and have fractional ownership. And so that's another opportunity to get started with real estate investing. It's another house hack. So there's a lot of things going on in the marketplace. I mean, obviously we're facing an affordability issue right now. I think we're going to see some changes coming pretty soon at the end of September and certainly into October. I think as interest rates start to drop, as manufacturing starts to increase, we're going to see this job market that's been so bad for 24, and it's been kind of struggling here into 25. I think we're going to see all of that change, and we're going to see kind of a confluence between price and availability, and we're going to start to see first-time home buyers come back into the market as interest rates drop and the affordability issue begins to decrease. So again, so just take a look. I mean, there's a lot of meat here to grab hold of when we're talking about the affordability crisis. There's a lot of opportunities for investors. It might be a little tough for the retail buyer, but again, I think if retail buyers would look at things more like investors do, they may find themselves having an opportunity in order to take advantage of where we're at. Because right now there's not a lot of buyers out there, and sellers have had properties sitting on the market. So maybe you look for the stuff that's the longest on the market and make offers that can fit with what you can afford, and then date your rate when interest rates drop, refinance it, and make it affordable. So I want to thank you for joining me on this episode of the Whitwam Wealth Real Estate Podcast. Please check out our previous episodes related to real estate investing topics. I invite you to subscribe today and be part of our growing community. You can always find the Whitwam Wealth Real Estate Podcast on Apple Podcasts, Spotify, iHeart Podcasts, YouTube, or wherever you enjoy listening to podcasts. This is Scott Whitwam. Be sure to join me on our next episode of the Whitwam Wealth Real Estate Podcast, where we're wealth building through real estate.